did have their expiry adjustment, and we did knock off about over 100 points in the Nifty futures. But having said that, the Smiths did make a comeback after multi-days of getting beaten down. But what lies ahead? Let's bring on board Dipan Mehta and find out what he's making of the market. Dipan, hi, good morning. Great to have you on the show. Dipan, seems like in a very wait-and-watch mode, and 26,000 continues to be this very big hurdle, at least for the index. But what are the observations that you're making on ground about investor behavior, about the kind of jugglery which is happening out of Smiths into large caps, etc.?
Yeah, Asha, good morning, and thank you for having me on your show. I think that investors are still a bit uncertain about the way forward. And the relentless selling coming from the FIs, of course, yesterday was a positive figure, but that the IPO markets and the kind of block deals which are taking place where promoters are exiting, that is kind of sucking up a lot of liquidity which is coming in through mutual funds and is causing some amount of, I would say, anxiety in the minds of the investors. And as such, I think the markets are waiting for a trigger for it to go beyond the previous highs, or even a solid negative kind of a trigger, which can take the markets down by maybe 1,000, 2,000 Nifty points. But as I see just now, I think we are poised for a big rally, maybe 6-7% type of a rally, or a correction depending upon the news flow. This kind of sideways movement has lasted for far too long. So I don't know, at some point of time, we're going to have a breakout, or a breakdown.
Dipan, if you can also give us a sense of how you see the broader market, especially mid-cap space there. We've seen some correction during the year for them. There's some bounce back in select stocks. How do you look at the mid-cap space?
Yeah, we're very positive on mid-cap stocks, no doubt about that. And that's where I think the alpha is going to come in terms of portfolio returns. So I think that one has to be selective in that space and look for businesses which have some differentiation or something innovative, or are kind of, giving an exposure to a very micro investment theme which is not otherwise available. So I think there are special situations as well. And those are the stocks that investors should be focusing on. But I'm firmly convinced that the way forward to get higher returns has to come from the mid-cap stocks. If you look at the entire Nifty list or the 50 stocks, on a long-term basis, there'd be hardly 10 or 12 stocks which can give even double-digit growth rate. So from that point of view, your choice is narrowed down to the small mid-cap stocks.
Okay, and Dipan, your reading on the IT stocks of late, we've been seeing some positive action. On Monday, we had a brokerage note also from Motilal that was rather bullish on the IT space. Given the kind of earnings we've seen, do you believe this sector stands at a re-rating point now?
See, I've been tracking software services companies for the last 32 years or so. And I've never seen a situation where such a strong technology trend has completely kind of, not had any impact on the IT services companies in terms of higher revenues or higher growth rates. If you go back right from Y2K, internet, whatever the other trends which have come through, remote management, application development, all of these trends, the entire digitization, that clearly benefited the IT industry. But when it comes to artificial intelligence, I think it has completely passed them. I'm not sure the reasons why it has happened, and hope that in future the AI is a strong force for the Indian IT services companies. But by and large, we haven't seen that just now. At the same time, IT services companies are underowned, and you could have a kind of a trading rally at any point of time. 8-10% upswing is easily possible. Numbers also may look decent for the March quarter because of base effect and because of a lot of the contracts which they have got on hand. They may start getting into actual revenue mode. So sure, you could have a 8-10% type of a rally in IT service companies at any point of time, but I'm not very positive on the long-term prospects of IT services companies. And the reason for that is that why has this entire AI wave completely passed them? In the past, whenever there was any strong technology trend, it meant a huge bump up in the revenues and profitability of IT service companies, which we are not seeing just now.
Dipan, if you can also take us through some of the defense stocks. BEL stock has run up nearly 40% since the beginning of the year. HAL has seen some correction of late, but if you look at the margin trade book, some of the defense stocks are there. HAL, Mazgaon, BL are some of the top stocks which are in margin trade book.
See, I think by and large, defense as a sector is pretty much well owned. It is well discovered. I think, reasonably valued as well. And although there is volatility in the earnings of these defense companies because they are essentially, I think, the nature of capital goods. So depending upon order execution, the revenues and profits do move in that direction. But it's a well discovered sector. And I don't think that by buying into these companies just now, you will make any superlative returns. But if an investor is not exposed adequately to defense stock, then at corrections, one could look at entering into these companies. And a strategy that we have been trying to evolve is that stock specific, wherever there's a disappointment in the earnings, and that happens from time to time and amongst all the large defense companies. So there's a disappointing quarter and the stock corrects 15-20% or so, yet the order book position remains pretty much strong. I think those are the companies that one could look at increasing exposure to. But by and large, I think if you have adequate exposure to defense, I think better to stay put over there and not look at increasing any exposure or reducing for that matter. Most of the defense stocks are a hold in our opinion.
Okay, that's the take right now on what you're seeing within the entire cap goods as well as the defense pack. But Dipan, I mean, one obviously doesn't buy stocks every day. But anything that you're keeping on your radar, waiting for it to either fall or, get convinced about the news flow and, then wanting to buy?
I think that, across the board, there are many interesting businesses. And if you go sector to sector, you will find a lot of companies which are in the sector, but which have different business models. For example, I think, within the auto industry, although we're very positive on the OEMs, there's a company like Car Trade, which is basically in the second-hand, the pre-owned vehicle business. And it's expensive at this point of time. Earnings have come through. So we're waiting, waiting for the stock price to correct or come at reasonable valuations. It's a great play on the auto industry. At the same time, it's got a very innovative and different business model as well. So something like that, again in the insurance business, although a lot of insurance companies are doing well, our preference is for something like a Medi Assist, which helps health insurance companies to process claims, or like a Policy Bazaar, PP FinTech, which is basically an insurance agent and provides a platform for selling insurance products. So these are the companies which are in our kind of a radar, that you like an industry, you find a player within the industry which is doing something different, could be a platform company or could have a different business model which rides the overall growth rate of the industry, but can grow significantly higher than the well-entrenched players. And such situations are there across the board. Within the travel industry, there is BLS, there is Yatra, like that. If you go sector by sector, there is something different happening within the sector. And for example, in construction business, there are all these prefabricated companies like Interac, developers, builders. I'm not sure the exact name, but like that, there are very niche businesses within a sector, I think, which may provide outperformance.
Interesting. In fact, we were just talking about Car Trade with Kunal, and Kunal called it the stock of the year, right? Kunal, the best returns made this year so far?
Yeah, I think 108, 109% for the stock. The second best, I think, is L&T Finance, which is at 90-95% so far, if I'm not wrong. So these are the only two performers which have done reasonably well.
But Kunal, how much more can Car Trade go?
So this is a very good question, Aisha, because I've seen this historically that when stocks run up
so
50, 100%, it might feel as an exaggerated return, but these are starts of big long-term uptrends which happen for stock. If there is a story, if there is news flow which is attached to these kind of names, only then you see such kind of price action. There have been historical instances multiple times that when stocks go into breakout mode, it initially needs that jolt of optimism to come out of multi-years of underperformance. And Car Trade for the last 3-4 years was hardly doing anything. It was almost at, I think, 1200, 1100 mark for a substantial period of time. Now the stock is at 3000 plus levels. But this indicates that we are looking at a multi-year rally which is building up for this name.
And are you bound to see some amount of correction or consolidation anytime soon?
So it happens. In fact, in the last 12 months, we've seen multiple instances where the stock has corrected 20% to 15% from its swing highs. I think the most recent instance was in the month of September, when the stock made out of 2600, and instantly in the next 1 or 2 weeks, the stock fell down to 2300, 2200 levels thereabout. So it has those tendency of giving you those 15%, 20% correction. Participating over there is a much more better strategy.
But then it's jumped up also over 100%.
Exactly.
What about a PB Fintech? That also is a stock that Dipan mentioned.
Yeah, so Policy Bazaar is again an interesting name. The stock has been a little bit more sideways, not performed very well in terms of the price trend the last 3-6 months. But then the stock has potential. We've seen historically also that the stock in the last year, if I'm not wrong, the stock had given a stupendous performance, moving up from 800 to almost 2000, 2200 in the previous year. And this year the stock has taken a pause. So short term wise, it may look like that the stock is consolidating, but when you try and juxtapose the last couple of years of price performance, it tells you that the stock is into a very strong uptrend, and within the phase of a very strong multi-year uptrend, it's going through a phase of a pause over here. So trying to take advantage over here at current levels of say 1700 for PB Fintech is a good strategy on a longer term basis.
Okay, and Kunal, you're reading on some of the stocks in the pharma space that have been abuzz on the back of some drug approvals coming in. Zydus Life in focus today on the back of that. Yesterday you had Dr. Reddy's. How are you seeing these stocks on the charts?
So pharma as an overall pack has been a slight, I would say, underperformer to a sideways performer. But then Zydus Life and Dr. Reddy are both of these stocks which have come back closer to their 200-day moving averages. I sense that maybe the other peers, the likes of Aurobindo Pharma, etc., they are starting to show signs of a momentum pickup. So which means eventually the likes of Zydus, Dr. Reddy, etc., they will also try and make a comeback for themselves. A better strategy over here is to buy these stocks either at their pivot points, which is their 200-day moving averages, or at slightly lower levels when these stocks come back to their previous major support. For example, for Zydus Life, that level is closer to 880, 885 on the short-term chart. So if these stocks happen to come back to that kind of a support territory, the risk reward is much more attractive to go for a medium-term buy into many of these names.
Dipan, if you can comment on the IPOs, we are seeing a lot of subscription coming in for some of the IPOs. Excel Soft, which is going to list today, nearly 45 times subscribed. You have Sudeep Pharma, which closed 98 times subscribed. So there is a lot of demand, retail demand coming in for these IPOs, and money going into the primary market rather than coming into the secondary market.
That's right, I think, and not all IPOs are bad. I think some of the venture capital funded IPOs, they are coming in a bit early than they would have, and that is causing some amount of, I would say, concern amongst investors, especially value investors, that they are trading at extremely high valuations. And on listing and 2-3 quarters down the line, also, they really tend to disappoint also. We've seen that likes of Ola Electric. I think Urban Company also has corrected significantly post-listing, and this trend is visible, Lenskart also for that matter. But I think, by and large, for every 2 or 3 overvalued IPOs, 1 or 2 IPOs do come which are very reasonably valued, which are businesses which are making solid profits as well. And investors should certainly focus on these companies, maybe wait for a couple of quarters or so, see for its listed history, and then maybe look at these companies after doing thorough research. But by and large, I would also like to add that there's a whole class of investors who are totally focused on IPO. They apply IPOs in multiple names or through leverages, and then they are flipping it on listing. And that particular strategy, that particular activity is still generating very, very good returns. So till that process is on, till that opportunity is there, I think IPOs will keep on coming and will keep on succeeding and doing well in the market. And it's only after a few quarters of correction or maybe disappointing numbers that the listed companies then tend to correct. So I think that is nothing to be concerned about. There is more than enough capital waiting in the country to be invested as well. And these activities are giving very good returns. So it's just causing more and more investors to come into this particular market.
Oh, yeah, absolutely. It's just so much appetite and so much money waiting to be deployed with new ideas. But let's talk about Kaynes Technologies. The company held its analyst meeting citing guidance for FY26 and beyond. Rabinder is here with the highlights. Rabinder?
Well, as Kaynes Technology management met with several analysts and some important commentary coming in from the analyst meet, where Keynes Technologies management believe that the Q3 FY26 revenue likely to be exit 1300 crore, taking the FY26 total revenue to 4100 crore. Remember that in FY25 company's total revenue was 2722 crore, and for EMS they said that the EMS growth will be driven by industrial, auto, aerospace, and they expect a recovery in the railway segment. And for the smart meter segment, management say that they are expected to contribute rupees 800 to 1000 crore in FY26, and for the Kavach railway safety system is expected to contribute of rupees 300 to 400 crore in FY26 of revenue. And management is confident of 30 to 35% EMS growth in the medium term, which is supported by new products and customer wins. And for the PCB facility, management highlighted that the PCB manufacturing facility commercial operation is likely to be expected in the FY27, and they expect EBITDA margin expansion of more than 30% from the PCB, and major PCB capex of rupees approximately 900 crore plan in FY28 to complete the Chennai expansion. And they expect 400 to 500 crore capex in FY26 for the PCB. Management has highlighted that given the revenue guidance from OSIT is rupees 100 crore in FY26 and 1000 crore in FY27. And for the margins, they said that the margins to be remain for PCB was at 5 to 8% for legacy packages, which is up to 25% for the advanced modules. And for the large multi-year capex plan, the company has a capex plan of rupees 8500 during FY26 to 29. So in short, management remain confident of continuous scale up across all business verticals and strong visibility on order pipeline, customer addition, and margin expansion. And medium term outlook remain robust with diversified sector exposure.
Right, okay, that's Keynes Technology sounding pretty confident about FY26. Dipan, how about this entire EMS space, darlings of the market, and then off late they've gone in a bit of a time-wise consolidation or correction mode?
Yeah, I think that definitely it's a sunrise industry, fantastic growth rates, and by and large, I think a lot of winners should come through over there. But just that the valuations are a bit daunting, and although the earnings are coming through for companies like Keynes and Dixon as well, but at these multiples to buy, there's a certain element of uncertainty. I don't think there's adequate margin of safety, but these are great stocks to track, and in a correction, or if you find that the P multiple has compressed because of exceptionally good numbers, but the stock has not moved up, I think those could be great entry points from an investor's perspective. So we're just searching for some amount of reasonable valuation or margin of safety to look at these companies in more positive light. But nonetheless, I think it's a very strong and secular industry with good fundamentals as well, great quality management, I would say decent corporate governance, fantastic track record as well. And certainly these companies will be significantly higher 3 to 5 years down the line than they are just now.
Dipan, what is your take on where quick commerce companies are headed, the listed ones at least? Because yesterday there was a very interesting note by Bank of America in their survey. It said that a lot of about 31% people in their survey, they prefer Blinkit. Then that is followed by Swiggy. Then you have your Flipkart and then Zepto. Now with Zepto coming closer to its listing, where do you think quick commerce companies are headed?
See, we're very positive on quick commerce companies, but these companies and these investments are not for the weak-hearted or the weak-minded. You need to have solid conviction and a really long-term view and the ability to grasp a lot of volatility which comes through in the earnings for these companies. But look, these are companies which will really thrive in 2030. And I just want to give a small example. We talked about car trade earlier. It is a perfect example of a platform company which was making losses for several years. And then once it started to break even and revenues continued to scale up, the operating leverages led to fabulous profits. And that is truly the journey of a great platform company. And if that plays out for all these quick commerce companies, then you will see them to be multi-baggers from these levels as well. But you don't know who the winners are, and you don't know whether actually they will be able to scale up to levels where they will be solidly profitable or not. But at some point of time, I think if they have the business model right, if they have the unit economics in place, then these companies can deliver fabulous returns from these levels. And our approach is to buy them as a basket. I think within your portfolio, at least 4 or 5% should be in such companies which are concept stocks, or which you think that, if they get the business model right, their profitability can scale to, levels which are unthinkable. And then I think these companies can give fantastic returns as well. So right now, it's difficult to value, it's difficult to assess whether they'll really be winners or not. So just buy them as a basket, remain invested, and if something performs reasonably well beyond your expectation, then gradually increase exposure. That would be the approach over here.
Okay, so that's your take on some of the quick commerce companies coming in. Lastly, Deepan, while we're talking about the entire consumption theme, it's been a mixed bag in the quarter gone by. Jewelry has done well, apparel, footwear, maybe not so much. Within the entire consumption theme, what themes would you be positive on? On what micro pockets look good right now?
See, we spoke about companies with innovative business model in a particular industry, and I gave the example of car trade, I gave the example of MediAssist, and also BLS, different companies. So now when it comes to retail, there's one company which comes to mind, although we haven't invested in it, but it's definitely on our radar. And as a measure of disclosure, we are very positive on it, is a company called Unicommerce. And that provides instantly, or rather in a very short period of time, businesses to start going online. And entire journey of going online is managed by this particular company and provides logistics as well. So I'm very positive on such businesses, looking for a right entry point over there where valuations are kind of justified and margin of safety is there. But look, the business model is very different. It's scalable, it's well established, it's got a great track record as well. It's just that it is expensive at this point of time. So if you get a nice entry point, then that's a great play on the entire retail industry. Apart from that, I think specifically, I think jewelry companies did exceptionally well. And that's one's a particular sector. I think tier 2, tier 3 did even better, like of say Kalyan Jewelers or Senco Gold. So investors certainly could look at these businesses in more positive light. But look, I think there could be a correction in these companies because of base effect. But by and large, we're very positive. And another company which comes to mind, which is a play on the entire jewelry industry, is Sky Gold. It's a company in which we and our clients are invested in as a measure of disclosure. Again, this is a company which has a very different type of business model, and it supports the entire jewelry retail rollout for a lot of the listed players.
Right. Quite interesting views there, Dipan. Thanks as always for your time. Good to be speaking with you.